Greetings and welcome to my Statement of Cash Flows presentation for Accounting 1120. If I sound excited, I am. I love this topic. It's one of my favorite. How about our first goal? My goal on this Christmas Eve, is to understand the theory of the cash flow statement presentation, or the cash flow statement preparation. The first thing I want to do is examine a little bit the reason why we prepare the statement of cash flows. The cash flow, or the financial statements that we have learned how to make to date, are on an accrual basis. They have nothing to do with cash. The cash flow statement, on the other hand, shows exactly where the sources of cash are from and the uses of cash have gone. So in a sense, it takes what we've done in the past on the accrual basis and converts it back to cash. It's kind of ironic, don't you think? We spend 2 semesters learning how to do accounting on the accrual basis, and then we teach how to flip it back to cash. The cash flow statement is such a completely cash flow basis that if you take the checking account or the cash account and you say, where did it start and where did it end, the cash flow statement would explain the difference by source and use. So the cash flow statement exactly explains the changes in cash. We can use the balance sheet equation to help us understand how we're going to do this. You're all experts at the balance sheet equation right now. Assets equal liabilities plus stockholders' equity. Let me expand the balance sheet equation to include a few different categorizations. I want cash by itself. I want to pull out current assets, and I want to pull out all other assets. I'm going to write OA for other assets. So I have expanded my asset side to include 3 categories: cash, current assets, and other assets. Now let's expand the liabilities. I want to pull out current liabilities from long-term debt, and now let's expand stockholders' equity. We'll have common stock. I'm going to leave out preferred stock, though I could put it in easy enough. We have our common stock accounts. We have our retained earnings accounts. Net income gets closed into retained earnings. We pay out dividends, and we have treasury stock. And I think I've included everything your author does in this section on expanding stockholders' equity. So what I've done is rewrite the balance sheet equation, but using more detail. Now I'm going to isolate cash. You only need to know a little bit of algebra for this, not much. Enough to know that if you subtract current assets from one side, you have to subtract them from the other, and other assets from one side, you have to subtract them from the other. And what we'll end up with is cash on one side of the equation. Current assets and current liabilities have been effectively moved to the other side. So we have current liabilities, long-term debt, common stock, retained earnings, net income, minus dividends, minus treasury stock. We subtracted current assets and other assets from this side. What I've done by rewriting the balance sheet equation is isolate cash. And what I'm telling you can do is to prepare a cash flow statement by looking at the change in all other accounts. And if you look at the change in 100% of the other accounts, it will equal the change in cash. I just proved that to you algebraically. It's the easiest way to make a cash flow statement, or otherwise you'd have to recast the whole year's transactions in a cash format. So we're going to look at the change in all these accounts and net them, and they will equal the change in cash. Now, a little word of caution. We have two kinds of accounts. Let me refresh something you learned in 1110. We can classify our accounts into two broad categories. Those that are permanent accounts, and those live on the balance sheet. And then there are those that are temporary accounts, and those are the ones that are closed. Revenues, expenses, gains, losses, dividends or draws, all of those are temporary accounts. The reason I point that out is the cash flow statement is a change statement. And we need to look at the change in every cash or every account. If we're looking at the change in a balance sheet account, let's say accounts receivable, if it starts at 500 and ends at 800, you know the change is 300. If we're looking at an accounts payable account, let's say it started at 600 and it ended at 500. You know the change was it went down 100. You can see by looking the beginning and ending balances of temporary or permanent accounts what the change was. When we're working with temporary accounts, it's easier. Let's look at revenue. Since revenue starts at 0, whatever its balance is its change. And since expenses always start with 0, no matter what their balance is, if it's 500, then you know that is the change, because they all start with 0. Hold on. So keep in mind, as we're looking at the change in accounts, permanent accounts, you need to know the beginning and ending balance of to find the change in. But temporary accounts, the balance in the account is the change in the account. Why is this important? Remember, the cash flow statement is a change statement. The fact is, we need to find the change in every account, and you can't leave one off, and that will equal the change in cash if you look at them in the right way. What we're going to need then is our financial statements. The cash flow statement is made last. It's not made last because it's the hardest, it's actually the easiest. Isn't that good news? It's made last because you need all the other financial statements done. For balance sheets, you need 2 years. Can you guess why? Well, on a balance sheet account, you need to know its beginning balance and its ending balance so you can come up with the change. So on balance sheet accounts, you need 2 years worth of financial statements. On the income statement, you need 1 year. Can you tell me why? And the answer is yes. Since income statement accounts are always starting with 0, whatever their balance is the change. So, to make a cash flow statement, you need to have 2 years worth of balance sheets, 1 income statement, and then you usually need to know the general ledger so you can look up other facts. Since we don't have a general ledger, you will be given facts. So we're going to use this format to proceed. I want to do one more thing with you. I want to develop a little terminology. What is the basic format of the cash flow statement? Well, we're going to look at cash flows from operations. We're going to look at cash flows from investing. And we're going to look at cash flows from financing. Lots of times they say activities. I want you to have a little understanding of what they are. Cash flows from operations, that is the actual cash that you generated as a result of operations. It's kind of funny. This whole time we've been teaching you to do accrual basis accounting, and now we're going to have you do cash flow from operations. If it goes into net income, it belongs in the cash flow from operations or cash flow from operating activities section. You'll have inflows, money you received, and outflows, money you paid. And you'll come up to a net cash inflow or outflow. Wouldn't you agree? Cash flows from operations over the long run need to be positive. Or what the heck are you doing in this business? The next section of the cash flow statement is called cash flow from investing. It uses the word investing a little different, especially when you look at the last chapter we did. You invest in your own assets as a business. You buy other assets and you sell other assets. When you buy them, it's an outflow. When you sell them, it's an inflow. So investing in your other assets is what we consider cash flow from investing activities. If you're green and growing, you're probably going to have outflows as a general rule, because you can't sell off your assets. You can't play that card too many times before you don't have any. Finally, cash flow from financing. How do you finance yourself? You have two sources. Do you know what they are? I'm hoping you remember, especially after the last chapter. You have debt and equity. You can borrow money, that's an inflow. You can pay it off, that's an outflow. You can sell stock, that's an inflow. You can buy treasury stock, that's an outflow. What we're going to do then is learn to look at cash flows from the slide. Cash flow from operations, or anything that you can turn into operating income, but on a cash basis. Cash flow from investing in your other assets, and cash flow from financing is how do you finance yourself. So there's a little bit of the background of the cash flow statement. We wanted to understand a little bit of the theory of the cash flow statement preparation. There's some theory for you.